Big changes are happening fast. A possible peace deal in the Middle East, the Fed's decision on interest rates, inflationary numbers, and a huge SpaceX IPO, with AI growing everywhere and really driving market growth. These things affect your family's money, protection, retirement, and your future. Today, we'll explain it all in simple terms. We'll cover the news, the trends, what do we see, where the market's heading, what are the cautionary tales. So let's get to it. Welcome to this next episode here at The Climb.
Life is full of choices, but how do all these choices connect? And how do we plan for what matters most? Because when your life goals align with the right financial strategy, you don't just dream, you climb.
We start with Iran and U.S. peace deals and potential geopolitical relief. First, good news from the Middle East. The U.S. and Iran have reached a preliminary agreement. A formal signing is planned for around June 19th in Switzerland. The deal reopens key oil shipping routes, extends ceasefires, and could ease some of the tensions from oil. We've already begun to see prices drop, where the price per barrel is around $76 to $77 per barrel. What does this mean for you and your family? Well, potentially lower gas and energy costs to help with groceries, bills, and bringing some relief. But these things can change quickly. That's why we always recommend having a strong emergency fund and diversification to protect you from all market and economic cycles. So let's put that to perspective. This means that we're optimistic. We hear the noise that, yes, the United States has entered an agreement with Iran, and the markets like this very much, to the point that it's already pricing in the effects of this agreement. This is why we're seeing the price per barrel going down. Now, does that mean that this is permanent and that it can't change? No, absolutely not. If anything, we know that change is always constant. So we have to be ready, hopelessly optimistic that things are getting better, that we're having a resolution, that this chokehold on one of the largest key points for oil transportation is finally finding some relief. And let's bring relief to the entire global economy. But let's not kid ourselves. These things can change quickly. These tensions with Iran and the United States are very real. And as we know, geopolitical risk tells us that these things can shift. These things can shift quickly on a moment's notice. So yes, we're hopeful, we're optimistic, we welcome this type of news, but we're always ready for the what ifs and the changes. So many ways to look at this, right? The world is clapping, we're happy, we're seeing that this potentially can conclude at least this chapter of the tensions between the United States and Iran. We obviously welcome for any conflict to end, as any loss of human life, and especially civilians and innocent lives. We all deserve to live in dignity. So if we can put an end to this, if we can negotiate, well, I think this is something we're all welcoming and we're happy for. But let's always plan for the alternatives, right? Let's always play devil's advocate and be ready for things changing by having an emergency fund to cover expenses or covering any potential price spike that we can see in the future by having saved money to cover any potential increase. So remember, planning is not just about looking at where things are or hearing the news of the day, but being ready and anticipating what can happen in the future, both negatively and positively. All right, so let's talk about the next thing, which is what's driving the economy and the markets. What's the noise? What inflation? And there are two simple examples of inflation: headline and core inflation. So let's explain what those two are and why that should be important to you. Headline inflation is the bigger picture. It includes everything. It prices things like food, gas, and groceries, but everything. This is what you feel the most when you're shopping or filling up your gas tank. Core inflation is very different. It excludes and leaves out food and energy because those prices are constantly jumping around. There's a lot of things that can impact the cost of these items. And what I mean by that is impact the cost of food and energy. Things like the weather, wars, supply issues, interruptions to supply chain. Core inflation shows a steadier underlying price trend in the economy. Why does this all matter, you may ask? Well, headline inflation shows the real pain in your family's budget. Right now, headline CPI, core price index, for May is around 4.2% year over year, the highest it's been in about 3 years. Most of that comes for higher costs in energy and food. Core inflation, remember excluding food and energy, is around 2.9%. The peace deal could help lower energy costs and ease this. This is why it's so important. So remember, as there's relief in energy and food costs, that should cause headline inflation to significantly lower. Will there also be relief in core inflation? Yes, potentially, because while it doesn't directly measure food and energy, and in fact excludes it, remember, some of these prices on these goods and services are indirectly affected by the cost of energy. Oil is in a lot of products, a lot of services, whether it's directly through some of the actual content of the product or material or its transportation of that. So yes, it can still have an effect on core inflation, although it should be more pronounced on headline inflation because the price of oil has been so expensive and now it's cutting sharply. We should see some potential significant dips in that indices. Now we know about headline inflation, we know about core inflation, but the question is, what is the Fed's favorite measurement for inflation? The Fed's favorite tool to measure inflation is called PCE, Personal Consumption Expenditures. What is PCE in plain terms? It's like a broader shopping basket of what your family actually spends on. It includes things like healthcare costs through your insurance. It tracks how people switch to cheaper options when things are expensive. So it prices in things like, for example, you choosing to buy chicken instead of beef because chicken is more cost effective. The Fed likes it because it updates quickly and it gives a smoother view of real trends. The Fed aims for about 2% PCE for a stable economy. Right now, it's running a little higher than that. Now, this is something worth considering. Even with headline inflation up, some companies are cutting back prices on certain items to keep customers coming back. They know that you're paying too much for gas and transportation. They know this. So they know that, hey, people are spending, they have the same budget, they have the same paycheck. Now they have to spend more on gas and transportation. So they know that in order for you to return to their store and keep buying, because now you don't have as much money to spend on their items, they have to cut back prices where they can. So they're doing so not only to help you, which we're grateful for that, but they're doing it so to keep customers returning to their stores. Another key point to consider, the Federal Reserve is holding rates steady right at 3.5 to 3.75%. New Fed Chair Kevin Warsh had his first meeting, and they watched for things like jobs, growth, and inflation closely. They're thinking, if we lower rates too soon and borrowing gets cheaper, people will spend more, and prices could rise again. What's the risk? Well, it can make inflation worse. Unfortunately, inflation is kind of like a seesaw. When you cut rates, yes, it brings relief to the consumer. It's easier to borrow. It's easier to buy a house, use credit cards, finance an auto, pay for loans. But on the other hand, it increases spending. And when we have more spending, if there's not enough supply or if there's overspending, that creates more inflation. So the Fed has a tough job. And that's one of the main features of the Fed is to find the right equilibrium balance depending on where we are in the economic cycle between stimulating spending and consumption and growth versus the economy overheating up and creating too much inflation and having to take contrarian measures, which means increasing interest rates, remove capital from the economy to lower inflation. How do we contextualize all of this? We discussed how the Iran-US peace deal is going to potentially help relieve the cost of energy, transportation. It should help with headline inflation, potentially core inflation as well. We know that the Fed is not making any drastic changes right now. It's taking more of a wait and see approach to see how these things continue to materialize and will make changes in the future potentially when they deem it's appropriate to continue to lower interest rates to stimulate the economy and consumption. Right now, the Fed is telling us that's not going to happen right away. Now, it doesn't mean it's not going to happen in the next couple of quarters. It potentially can. But for those of you who are holding your breath, waiting to have lower rates in order to make a purchase or a buy or even to sell, this should be something you should take in consideration. Say, hey, okay, the Fed made a decision that it's not going to lower rates, so I shouldn't expect immediate relief when it comes to interest rates, and I should plan accordingly. Does that mean that you need to completely pivot from your strategy? Hopefully not. Hopefully, that small percentage of potential rate change, which could be significant, but hopefully it's not significant enough where it's completely overhauling your financial plan or your goals and objectives. Hopefully we plan for that. If not, work with an advisor so that you can really have metrics, define goals, objectives, where you're taking consideration market changes, volatility, lifestyle changes, market changes, like all the things that could potentially move and pivot your plan. This is part of planning, is always taking consideration the what is and the what's can happen. So now let's talk about the stock market rally. Let's talk about concentration growth in the market and the SpaceX IPO. Let's look at a deeper dive. The stock market has had some strong gains all this year, especially in technology and particularly AI invested companies or in companies that are somehow tied into information technology or AI. Although we've seen some pullbacks. We saw it from February, March, April. We saw some volatility. Doesn't mean that the market is not going to have drawdowns. It doesn't mean that AI is the only place to invest, but it's worth noting that this year it's really pulled the markets as it has, I would argue, for a very long time, but we've seen some significant pull from these sectors since the pandemic. Now, SpaceX has just had the largest IPO ever, period, okay? It was priced at $135 per share. It raised about $75 billion. The stock jumped after its launch, pushing the company with a valuation of over $2 trillion. Can you believe that? Over $2 trillion. It's exciting? Sure. It's rockets, satellites, and AI technology. But here's the reality. Many IPOs pop at first, and then they get really bumpy. SpaceX looks strong in the short term, but valuations are high compared to current profits. Heavy investments in future technology. The broader markets are also trading at elevated levels, which is argued that it's supported by AI growth. But there's always risk. And there's concentration worry. A handful of big tech companies, AI companies like NVIDIA, Microsoft, are what's driving the most gains. And this is higher than usual, like the dot-com era. But the difference here is that there's actual earnings behind this cycle and movement today. If they stumble today, the whole market feels it. Now the question is, what should you do? Well, first, don't ignore it. Tech growth is real. It's creating real jobs, real opportunities, and tools. AI is as innovative in its transformations as any industrial revolution that we've experienced. But remember, don't put all your eggs in one basket. Diversification is key. Use broader ETFs or indices and invest in funds that better give you exposure to other sectors. Betting big on one stock is simply very risky. It's taking a concentrated approach. It's saying, hey, I'm going to put all my eggs in one basket. And you know, if that doesn't play out, we can have some real significant losses. Now, does that mean that you avoid taking risk? Remember, investing is ultimately about risk reward. The more risk you take, the higher reward you can have, the higher exposure to losses. So always ask yourself, what is the right tolerance that you have when it comes to the risk that you want to take with your money? And create a strategy aligned with those objectives. Work with an advisor if you can, or work with an advisor and make sure that your investment strategy is aligned with your risk tolerance, your time horizon, and your investment objectives. And remember, keep a long-term view for things like retirement, your kids' education, building legacy. You know, I tend to want to deviate from strategies that focus so much on the short term. Markets are very hard to predict from one day to the another. But if you have a longer approach, so a long-term strategy that takes in consideration your ultimate goals, I think you'll be better suited to ride different cycles, ups and downs of the market. In my chat with a venture capitalist who invests in AI, we talked about what AI can do, smart tools, business use, and what's coming next. AI powers a lot of things like market rallies and future growth. Even with these macro shifts, it can help small businesses, entrepreneurs, in our communities and make life more efficient. But remember, there are risks too, like overhype, overconcentration, over-focusing on one sector, ignoring the rest of the market and the economy. These are real risks and challenges. Balance is always key. In our next interview, we go into a full conversation with someone that knows or is exposed to the ever-changing world of AI and venture capital. Stay tuned for that episode and that interview that will be coming next week. So here are some actionable takeaways and holistic advice. How does this connect to your real needs? Well, first, build protection, have strong emergency funds, and make sure you do an insurance check to make sure you have the right insurance coverage. Handle debt smartly with these rates. Diversify investments. Don't put everything in a few names. There's always going to be something. I wanted to dedicate some time to go over what we're seeing now because we have a lot of noise right now. We have a lot of changes happening and coming at us so fast. The question is, do I pivot? Do I overhaul my strategy? My suggestion is always work with your advisor and make sure that whenever you're planning, you're not just planning for the noise of the day. You're planning for the next 5, 10, 15, 20 years and plus. Because you need to have consistency in the way you approach things, right? You can't be easily moved because then you just become a market chaser. You become someone that's chasing the speculation, the news of the day, and that's where real losses tend to happen. Not always. Next week, we have an insightful conversation with our venture capitalists who invest in AI. We have a packed insight on where technology is heading, what can it do for you today, and how to get some exposure to in venture capital. Thank you for joining The Climb. This is Isai Juarez. Keep climbing, protect your family, build your future, and we'll see you next time here at The Climb.